As you may already know, this webinar is designed for our clients, family business, group companies, CFOs, and in general, high net worth individuals with complex business structures. So before we start and before I introduce our tax experts, I would like to go through a couple of housekeeping points with you. First of all, this webinar will be recorded and actually is being recorded, and we will share with you along at the end of the session a key takeaway document. So don't stress too much with taking your notes. Everything will be shared with you after the session. Yeah. And second, the participants are anonymous. So if you have any questions, I will invite you to send your questions through the Q&A box, which you will find at the bottom of your screen. The chat option will not be available in this webinar. So if you do have any questions, just use the Q&A box at the bottom. Okay? So today in this webinar, we will be covering the following important topics. First, transfer pricing fundamentals and disallowance of intra-group services, directors, and management fees with risk mitigation points. Now, I would like to introduce our tax experts. And starting with the ladies, Kirti Vudimudi is Rethink's Director of Tax. She's focused on strategic advisory and optimization from a UAE corporate tax, VAT and ESR regulations perspective. Kirti, welcome to this webinar and thanks for joining us this morning.
Hello, Kat. Pleasure to be on part of this webinar.
Thank you. And we also have here with us Christos Teofilou and Gaspar Lopez Dias, who are the partners in Taxand, specialized in international tax and transfer pricing. Gentlemen, thanks for being with us and welcome to this webinar. All right, so let's get started. Kirti, I hope you're ready. My first question will be to you. So please, Kirti, could you start this session giving us a quick overview of transfer pricing?
Sure, Kat. Let's discuss transfer pricing in simple words. Transfer pricing is to ensure related party transactions are at commercial rates. The UAE transfer pricing provisions are similar to the OECD provisions. However, in the absence of a personal income tax in the UAE, there is an additional requirement to apply transfer pricing to connected persons as well. We will discuss related parties and connected persons shortly. In the meantime, when unrelated parties engage in transactions, the terms are typically decided by the market forces and negotiations. However, transactions involving related parties may not be influenced by market forces. It could be affected by the relation and control they have on each other. In such cases, these transactions could result in reduction of profits and could also result in reduced tax liabilities, and hence the need for a standard transfer pricing regulations across the UAE. Now, internationally, the recognized standard in pricing such transactions is arm's length principle. The arm's length principle treats related parties and connected persons as separate entities and not as parts of a single unified business. These control transactions may include provision of service, sale of tangible goods or intangibles. It could be financial transactions with related parties and connected persons, etc. Let's expand further on this to discuss on the related parties. Can we have the first slide, please? So for our ease of reference, the definition is shared on screen. Related parties, when it comes to individuals, it is up to the 4th degree of kinship between the individuals. When it comes to entities, it is 50% or more ownership. It could be direct, indirect, it could be common ownership between the entities. The entities would result being a related party. A person and its permanent establishment is also a related party. Partners in an unincorporated partnership are related. Partners with the unincorporated partnership are also related, obviously. And most importantly, I think very relevant for our participants today is the founder and the foundation are related. Trustee and the trust are related. Similarly, now, connected person definition. Now, this is a definition very unique in the UAE. It's important for us to understand this definition. The owner of a taxable person, director or officer of a taxable person are considered connected persons, and any related party of the connected person is also a connected person. Now, as you can see, the definition of related party and connected persons are wide. This includes individuals, controlling parties, relatives, hence requires great attention to determine whether transfer pricing applies to a transactions between these entities. Now, with the UAE transfer pricing regulations in full force, I am excited to get the input of the participants here. Let's take a moment to answer a couple of poll questions. Can we have the first question on screen, please? So the first question is, how well are you prepared for the UAE transfer pricing regulations? Option A, well prepared. Option B, made some arrangements. Option C, have no clue. Please do not be shy. Feel free to answer the questions. Your answers are anonymous. It would be interesting to see the polls. Let's give a minute for the participants to answer the questions. The questions you can see on the right-hand side of the webinar. Can we have the poll answers, please? The results, please. We can see the poll results any minute now. So I can see that 55% of the participants have made some arrangements. It is quite genuine that transfer pricing regulations are new, and hence not being fully prepared for the transfer pricing regulations is quite normal. There are no votes on well prepared, so nobody is entirely prepared. So it very well reminds us why we are having the session today. So 52% have made arrangements, 48% have no clue, 0% well prepared. So it's genuinely natural for people to have no clue about the transfer pricing regulations, given the regulations are new and transfer pricing is entirely new in the UAE. For others, it may be you may be aware of transfer pricing from other countries, but not in the UAE. Now, these are definitely some interesting results. Let's dwell into the concept of transfer pricing requirements. Before we discuss what is transfer pricing requirements, can we have the second question on screen, please? So the second question is, what are the transfer pricing requirements? As you understand, you can answer the question. Option A, comply with arm's length principle. Option B, prepare for transfer pricing documentation. Option C, disclose the transactions to the FTA. Option D, all the above. I can see people enthusiastically answering the question. Let's give it one more minute. Can we close the question, please? Perfect. The poll is logged. I'm to see the results. Well, before I see the results on screen, 87% of you, yes, I do have the answer. 87% of the participants feel that it is all the above. And that is the right answer. I'm really happy to see most of you on the same page in terms of the transfer pricing documentation. So to look at the first answer, comply with arm's length principle. Um, the transfer pricing, the taxpayers must adhere to the market rates. It is important to note, even in absence of a formal agreement, the transactions must be at arm's length. Now going to the transfer pricing documentation, that is the option B. 9% of you mentioned it is only transfer pricing documentation they should be focusing on. Uh, Before we discuss further, what is transfer pricing documentation? It is a collection of records created by the taxable persons to show their adherence to arm's length principle in the transactions with related parties and connected persons. The main goal of transfer pricing documentation is to give authorities a thorough understanding of companies' transactions, the transfer pricing policies, and the implementation, and to help assess whether the transfer pricing results for each period under review are in compliance with the transfer pricing regulations. Now, transfer pricing documentation can comprise of, can we have the second slide on screen, please? It comprises of a disclosure form which must be submitted along with the CT return annually. You all know that CT return is to be submitted within 9 months from the end of the financial year. CT disclosure form goes along with it. A master file and a local file must also be maintained for entities, the group multinational entities with group consolidated revenue exceeding 750 million euros. So if your entity is part of a multinational entity, master file and local file must also be maintained. And even in other case, if the UAE entity's revenue exceeds 200 million dirhams, even then master file and local file must be maintained. In addition to this, a country by country reporting is also required for UAE headquartered multinational entities. This is applicable if your ultimate parent entity or the alternate parent entity as assigned by the parent entity is in the UAE, it is located in the UAE. It is not applicable for general constituent entities. So in summary, every entity with a related party transaction or a connected person transaction must submit a disclosure form to the Federal Tax Authority as a bare minimum, and the rest of the documentation is applicable for large businesses.
Okay, great. Thank you, Kirti, for your thorough explanation. That was very clear. So I understood your concerns about complying with transfer pricing regulation, but what if the transfer pricing requirements were not complied with? What are the consequences?
That is a very good question, Kath. Definitely important. Non-compliance with transfer pricing requirements can result in adjustment to the transactions by the FTA. This will result in additional liability of taxes, also penalties possibly. And FTA has discretion to disallow the transactions that are not at transfer pricing if it is not met with the arm's length principle. Additionally, it is important to note, very key point here today is that in case of non-compliance with transfer pricing requirements, the free zone relief will be lost. And not just for one year, it is for a minimum of 5 years.
I see. Well, I believe that losing the free zone relief is not an option to any business here. That's why it's paramount that the transfer pricing requirements are always observed, right?
Yes, that is right, Kath. So let's summarize the fundamentals. There are 4 key points I want our participants to take home today from the fundamentals. Plan ahead by analyzing the tax implications on the group of companies and wherever possible, optimize taxation. Second, review the transactions to identify whether they fall under transfer pricing control. We discussed related parties and connected persons, so it is important to review whether there are any such transactions. Third, action by adhering to the arm's length principle. This could also include arranging for transfer pricing studies and documentation where required. And fourth, transfer pricing has to be maintained annually. It is not a one-time requirement. It is something to be updated annually.
It's
These
great.
are the 4 points.
Thank you. Thanks, Kirti, for your answers. Very clear. Um, So now my question will be addressed to Christos from Taxand. Christos, what common and practical scenarios do you recommend everyone should focus on?
Hi, Kathy, and thanks for the excellent question. And let me welcome everybody to this webinar as well. So in practice, when it comes to intra-group services, the tax authorities typically challenge the transaction when there is no economic substance from the service provider to the service recipient. The typical transactions that we see in practice that the tax authorities around the globe, they challenge these transactions are the so-called management fees. So when the group charges management fees within the group, these management fees are typically challenged by tax authorities for the simple reason is that management fees is generally understood as the basket bin, so it doesn't have any actual definition. And for this reason, the MNEs, they typically dump all their services that they actually are not able to justify. So for this reason, management fees are a red flag. So this is the one, and I will be giving you an example today here. And the other one is effectively the director fees that my colleague Kaspar is about to present in a few minutes. So let me share my views on management fees. We are now seeing the typical structure of management fees in our screen. And here, as you can see, is that first you have a service provider, which is located in the UAE and has made an intra-group service agreement with its affiliate to manage its affiliate. For example, maybe the affiliates are located within the EU or in Africa or in the Gulf area. It doesn't really matter. It can be anywhere. This service provider can be the parent entity that provides support within the group, or it could be the regional subsidiary of a big MNE. Let's say you are a US multinational and you want an efficient way to manage your affiliates within the Gulf region or within the EU, and you set up your regional subsidiary in the UAE. So then the affiliate, which is resident, for example, in the EU or in Africa, will effectively be paying these management fees to the service provider located in the UAE. Now, what is the key issue here that we need to know in practice is that the tax authorities, the foreign tax authorities in the jurisdiction where the affiliate is resident, would like to challenge the excessive expenses, the excessive management fees charge. So let's assume that the service provider charges the service recipient 2 million dirhams per year, and then the foreign tax authorities, we might say, listen, this 2 million is excessive. You are effectively increasing your expenses to reduce my tax base and therefore the tax payable, and I would challenge this transaction. So what you need to have in mind is effectively two things to protect your interest. The first thing that we see with clients is that we need to perform the benefit test. What is a benefit test? The benefit test is a test that says that if the company, the service recipient, the service provider does not pass the benefits test, it means that the management fees charge at the level of the foreign affiliate will be disallowed. Disallowed means that for tax purposes will not be accepted, and this will increase the tax base in the foreign jurisdiction and therefore the tax payable. So what is a key question here is how you meet the benefit test. And the test that we effectively do in practice with respect to the benefit test is a two-way test. First, we look at the service recipient, and then we look at the service provider. So let me start from that. The first question is that we will go in, and let me make this practicable. We go to the service provider, which is the UAE entity, and we test whether there are actual people there. So we need to see actual people. This is what the tax authorities will look at. Are there any actual people there that actually render these services? So they need to see people doing this service. After we say that this is correct, then we turn our look to the service recipient, which is a foreign affiliate, and then we need to see whether the service provided by the service provided by the UAE entity confer any economic or commercial value that enhances the service recipient business proposition. And how we do that? We are trying to find evidence of whether an independent service provider was willing to pay for this service or was willing to perform this service in-house. If this is correct, what we typically do in practice is that we are trying to identify the need of the service recipient, what need have we satisfied in order to receive this service. However, we need to be very careful that there are certain activities that the OECD transfer pricing guidelines say that they do not meet the benefit test by default. And these services are shareholders' activities. Shareholders' activities are predominantly not accepted by the OECD transfer pricing guidelines, and they are typically included in the so-called management fees that we typically charge around the globe. Let me give you a practical example. What is shareholder activities? For example, the cost of raising funds for the acquisition of participants, or cost for compliance for the parent entity for the relevant tax law, or cost for doing the consolidation reports. All these costs that they are done typically at the parent level or regional level are typically not charged by shareholders' activities, are not considered to be intra-group services. So despite from the fact that you might have any agreements in place and these transactions are valid, they will not be chargeable in the hands of the service recipient, and the foreign tax authorities will disallow the whole amount. So this is the first test that you need to be aware. The second test is that if you pass the benefit test, so we have done all what we said right now in practice, then we actually go in, we benchmark the transaction. So as soon as the benefit test is met, the transaction is fully recognized, then we move on to benchmark the transaction. And if the transaction, let's assume, is 2 million dirham, but actually, when we look at in our databases, we find third-party comparables, and that third-party comparables is 500,000 dirhams, then the foreign tax authorities will disallow the expense up to the arm's length amount. So the tax authorities will accept the 500,000 and they will disallow the 1.5. So let me sum this up. It's two things that you need to be aware of when it comes to intragroup services, and this does not apply just to management fees, but applies to all intragroup services, but I'm referring specifically to management fees because it's a red flag for tax authorities around the globe. The first thing is that you need to meet the benefit test. If you fail to meet the benefit test, the whole expense is disallowed, and provided that you meet the benefit test, your transfer pricing local file and benchmarking needs to be aligned with the contractual arrangements with the arm's length principle. I think I have fully covered the session, and I will be handing over to my colleague Gaspar in order to explain another very important area in intragroup services, which is director fees. Gaspar?
Thank you very much, Christos, and hello everyone. Pleasure to be here. So I'll try to address two important points regarding director's fees. One is how the scope of the rules transfer pricing applies to director's fees, and the second one is why is that important and what should be done about it. So in terms of the scope of transfer pricing rules, as we mentioned, there are prescriptive definitions of associated parties and connected persons. It's important to consider that with respect to director's fees, there, in principle, if you have a relationship between a company and another party that is not strictly connected, that is, in principle, a third-party relationship. Directors are specifically mentioned in the legislation as being a party that is associated or connected to the company. So directors, by definition, are going to be in scope of TP rules, And that's because the relationship between the director and the company is never an independent relationship, because the director acts on its own account as an individual or as a company, but also acts on behalf of the company that he's a director of. And that's a bit of a different relationship than an employee. An employee is in principle independent from the company, and contracts and an employee, a labor income that results from an employment relationship is in principle a third party relationship, but not necessarily, because as we've seen, the test is a factual test. So if the employee is able to control the company, either because he's also a shareholder, he's also a director, or for any factual reason has the power to impact the decisions of the company, then the employee income may also be subject to transfer pricing rules in a similar way to directors' fees. So that's the scope of the rules. To summarize, directors' fees are in principle in scope. Labor income is in principle out of scope, but it can be in scope if the employee is also able to control or affect the decisions of the company. So the question is that an independent relationship, or is it a relationship that is for which that person has a control of the other position, of the company's position? Then, of course, we would need to consider several sets of rules. If we have a company in the UAE with a foreign director, you would need to consider the TP definition and the TP rules in the UAE and in the other jurisdiction. And vice versa, if you have a director in the UAE of a foreign company, then you would also need to consider both sets of rules. Domestically, if you have either one, you would need to comply with transfer pricing in the UAE. In addition to that, you may also have to comply with transfer pricing documentation in the other jurisdiction. But that's also important because if you are in a situation where in one jurisdiction you're subject to TP rules, but not on the other one, under tax treaties, which are bilateral agreements between those two countries that allocate taxing rights between those two countries, it's going to make a difference whether you're in the scope of in the scope of transfer pricing rules in both jurisdictions or not, because of the impact of the possibility to get relief from double taxation in the other jurisdictions through the tax treaty and through those mechanisms, and also to start a discussion between tax authorities through the mutual agreement procedure. Now, what happens when you are in the scope of the rules? The first thing that I want to highlight is that transfer pricing, even though the name includes the word pricing, yes, it requires taxpayers to document that the amount of the prices for intergroup transactions, including directors' fees, are at market. The word we use is at arm's length, which is somewhat broader, arguably. But also the conditions, meaning that the terms and conditions of the agreements or of the transaction need to reflect what third parties would have agreed. So if that director and that company would not have been in that relationship that is a controlled relationship, what would they have agreed? And it's broader than the price, because if and this also goes to quality in terms of selecting your service provider. If you move on to pricing without really considering the conditions that are going to be priced, that's an easy challenge for tax authorities, and that's in fact going to make a difference. So you can have a benchmarking analysis that supports the price for the director's fees, but if that does not really consider the conditions, the terms, that the broader circumstances of the transaction, and support that those are at arm's length, then your transaction is going to be set aside very easily. And that's sort of a substance over form type of rule that kicks in there through the 5 comparability factors that are mentioned in the OECD transfer pricing guidelines, to which the legislation makes reference. Then the next step is to select a transfer pricing methodology There are 5 methodologies recommended in the OECD. You could select more than one methodology. And as you see probably on the slide, I'm not sure everyone can see my slide. Right, there we are. So just to put some numbers to what I'm discussing, if we have, let's say, 2 million dirhams of a director's fees, the question is, you'll need to think about the position of the taxpayer as the company or the director. So for the director, that's going to be taxable income. So if the director is in the UAE, and by the way, the rules apply both to cross-border situations as well as domestic situations. I mentioned in particular cross-border situations because those are situations that are harder to deal with in terms of relief of double taxation. Now, in the UAE, so if you have an adjustment by the authorities at the level of one party, the question is that you need to have a corresponding adjustment at the level of the other party in order to not end up with double taxation. So the rules have this anti-avoidance element, but also because they allocate income between countries, there's the potential to also have double taxation if the rules are not well integrated. And that's also where tax treaties are very important. In particular, also the link between transfer pricing and Article 16 of the treaty, which covers directors' fees and whether the source country can have the right to tax. So in terms of the 2 million dirhams, we see if you are the director, or from the perspective of the director, it's important to consider whether that's sufficient. So if you have a study that says that the market price should have been higher than 2 million dirhams, then that means that additional income is going to be imputed at the level of the director. If on the contrary, the market price should have been lower than 2 million dirhams, then that's not a problem for the director because he has reported more than what the market price is. But it's going to be a problem for the payor, the company is going to have an excessive deduction. It has deducted 2 million in its tax return. But in fact, it should have only deducted a lower amount, so the excess amount is going to be denied. The deductibility, the tax deductibility of that excess amount could be denied by the tax authorities. So that's the perspective that that should be borne in mind. To conclude, I would say that selecting the pricing methodology is as important as looking at the circumstances leading to the pricing of the transaction.
Okay, great. Thank you, Christos and Gaspar, for your input. That was very clear. I'm a bit concerned about time, so I suggest perhaps we jump into our Q&A session. We have received several questions from the audience. Thanks for participating, all of you. My admin team is selecting a couple of questions as I speak. I can see a couple of questions coming up here in my screen. Okay, I have the first one here in front of me. I'm going to ask this question to Christos from Taxand. Christos, the question here is, we have a group transfer pricing policy. Can we use it for the UAE companies?
Thank you, Kathy, for the question. Actually, being proactive and the group having a transfer pricing policy is a critical, I will say, an essential part of meeting the arm's length principle within the group, because in the absence of a group transfer pricing policy, you might end up in a situation where for example, the service provider uses one methodology and the service recipient uses a different methodology, and you end up with different results for the same transaction. So following the group transfer pricing methodology, I will say that the transfer pricing policy is an essential part for the group to maintain this document, although a lot of groups from our practice, sometimes they fail to have this policy document because it's not an obligatory one. So you have to be proactive and not reactive to have a group TP policy. But I will say that the groups that they have TP policy, they have the benefit of having their contractual arrangements aligned with the arm's length principle, and the quality, the transfer pricing quality of your TP memo, I will say this will give you the benefit of following this group TP policy and meeting your ARMEF principle. So I will say this is an excellent question. Groups, they need to have proactively a TP policy document and follow that, because we also see in practice that we do have a TP policy document, but sometimes the methodology deviates from the practice. So I will say, yes, you need to use it, and you need to have a very good contemporaneous TP policy documentation in practice.
Mm-hmm. Okay, clear. Thank you, Christos. Now I have a second question here that I will ask Kurti. So the question is, what type of transfer pricing information do you expect to be disclosed in the corporate tax return? That's a very good question. So Kurti, please.
Indeed, Kath. It's a very good question. The return form, the corporate tax return form, is not yet published by the FTA. Based on the recent drafts available, we have happened to see some information. From that, we can see that FTA mandates to disclose certain adjustments to the related party and connected party transactions. This could be adjustments where they do not comply with the transfer pricing methodologies. And also, as previously discussed, there is a disclosure form to be submitted along with the CT return, which includes the nature of control transactions, value of control transactions, related party transactions, and the methods used to determine the arm's length principle. In fact, that is the summary of all the related party transactions and how you have arrived at it, right? So all of that is expected to be submitted along with the return.
Okay, perfect. Thank you, Kurti. Another question that just came up here. Is there any transfer pricing requirements for trustee fees to private trust companies? And I'm going to ask this question to Gaspar. Please,
Thank you
Gaspar.
for the question. So the rules have a legal element, a legalistic element. So then if you are in scope of the relations that are specifically mentioned, then you are in scope of TP rules, but they also have a broader concept of connected parties or connected persons and parties that have effectively the ability to control each other. So that could include things like a supplier that has economically a lot of impact, or even a customer. And if it's the sole customer or commanding a significant percentage of the revenue, that could be qualified as an entity that has control. Specifically, trustee fees are mentioned, so they are in principle to be covered. Now, obviously, the trust will have relations that could be also within the scope of the rules between the trust and the investments or other companies that are either under common control, management, or ownership. But also the relationship between that party and other directors or trustees could be in scope of the rules. Now, relationships with external providers would typically not be in scope of the rules, but that's the principle.
Okay, thank you, Gaspar. I can see many questions coming up here. Thank you guys for participating. That's awesome. So another one, Kurti, this one is to you. Are there any specific rules and regulations depending on different jurisdictions?
Well, within the UAE, there are none. The transfer pricing applies to UAE mainland and free zone entities equally, and to all the Emirates as well. It is applicable equally. But when it comes to multinational entities, there are international unilateral advanced pricing agreements and tax rulings that can be applied to understand the profit attribution between the countries.
Okay, good. Thank you. I think we do have time for further questions. If not, then admin team just tell me to shut up. So, but I'm going to keep on asking these questions because people are just asking questions here. So fine. Oh, we have another 10 minutes. Thank you. Great. So the next question to Taxand team, and I will let you guys decide who should answer that question. Does transfer pricing non-compliance impact my audit report?
Let me pick it up if I am allowed, Gaspar, and of course, Pobin, to share your views as well. Of course, I mean, the auditor's report, depending on the country of the auditor, but typically the auditors follow the international standards of audit that says that we have a materiality of the transaction. Of course, the tax consultant and the tax authorities, they don't have this materiality test. However, the auditor report has a materiality test. And typically, the tax included in the financials is a provision, as any other provision that we prepare in the financial statements. And depending on the materiality of this provision, the auditor might have a liability, because despite from the fact that you prepare a transfer pricing study, and the guidelines, of course, are like 700 pages, but they do only one thing. What they do is that they determine the quantum, the amount of the transaction. So if the quality of the transfer pricing study is not at the level that the tax authorities are expecting, and they also deviate from the OECD transfer pricing guidelines that the authorities are expecting to see, and maybe the auditor might say that I cannot rely on this report, and I don't think that the transfer pricing study leads to the arm's length amount, the quality of the report. So the auditor must be in a position to assess the transfer pricing expert and to accept that the provision that the auditor will apply in the financial statements, it is adequate. And this happens in any audit report. I mean, the auditor needs to be in a position to assess any third-party expert that appears to have a report in its financials, like you have a property, plant, and equipment, and immovable property, and you do an evaluation, and then you need to assess the reliability of the valuator's report. Typically, I would say the same applies for the transfer pricing report. However, if the question is for the tax return, the threshold is much lower, because we all know for tax, there is no such thing as materiality.
Okay, great, thank you. I think we have 5 minutes left, so I'm going to ask another question again to Taxand. Can you comment on threshold on the control transaction and TP documentation, please?
I would say that the thresholds that they are applied by the UAE tax authorities are reasonable. And this is what the guidelines are effectively saying, that you don't need to price all your transactions, but you need to apply a materiality test. And as always, you need to take into consideration the compliance burden and the benefit of the taxpayer. So you don't need to prepare a full local file for a low value amount, because at the end of the day, the compliance cost overrides the benefit. So I would say that the local threshold requirements are reasonable.
Okay, thank you, Christos. Well, I think we answered all the questions. We have other questions here, but I don't think we have time to. Let me just check. Do we have time for one more question? Do we? Yes, you have time. Okay, all right. So I'm gonna ask a final question that I have here. Sorry, guys, it's just coming up, all the questions here, and we are live. So how long is a benchmark study valid for? Christos or Gaspar, whoever wants to take this question.
Right. I would say that in approaching TP documentation, it's important to not just look. Well, I just want to tackle this question from the very beginning. A benchmark study by itself does not support that your transfer pricing is not sufficient transfer pricing documentation. You need to then, so the OECD standard is a master file, a local file, and a country-by-country reporting if you're in the scope of that. But leaving that aside, the local file is really the standard that covers all taxpayers and all transactions in a given jurisdiction, such as the UAE. So you would need to have the local file prepared in each country. That's annual, as Curtis said earlier. And the benchmark or benchmarks that you include in the local file are going to depend on the nature of the transaction. So, for example, you will have benchmarks that are prepared for a transaction when it is first entered into, and then financials could be updated annually, but the benchmark would only be revisited every 3 years if the economic circumstances don't change, if the functional profile, that means the type of activities that the parties to that relationship perform, do not change, then we would remain, the benchmark would remain applicable. And so the nature of the applicability of the benchmark will depend on the transaction. If we talk about, for example, loans or other financial transactions, those are typically priced when the loan is granted, and you would only reprice it if there would be, for example, a reason for the borrower to refinance its loan. So those are sort of special cases there.
Okay, Gaspar, thank you so much. So we have one last question that just came to me. Curti, is transfer pricing applicable for transactions between two related UAE mainland entities? If yes, can you kindly advise the rationale of the same, or as both entities are under the same tax bracket?
Sure, that's a very interesting question, Kath.
Very specific question. I'm sure it
Very
was
specific,
asked by
yes.
someone that knows the tax regulations very well.
Indeed, indeed. So the point is, the question is understandable. The entities are in the same bracket, tax bracket. There is no tax evasion here. Then why transfer pricing requirements? First of all, is it applicable? Yes, it is applicable for mainland entities as well. Why at this level I would say it is a requirement under the law, but practically the rationale could be that FTA should not have to verify whether a company had met or whether there is a possibility of a tax evasion or not after comparing the transaction, who the transaction is with, or what is the other side of the transaction, etc. Instead, it should be an easy forum for the tax authority, an easy methodology for the tax authority to understand compliance with the tax requirements. So it is easy if transfer pricing is at a standard level. That is point one. However, I do see at the time of audits, maybe at the time of risks, I would, in my personal opinion, FTA may not be focusing on these transactions too much, given that tax evasion is less, right? I mean, it only makes sense from a logical perspective that they fry the bigger fish. They think of something where tax evasion is possible. They spend time on that than a transaction between two mainland entities. Summary, yes, applicable for domestic mainland entities as well. Important to comply with, and I think it's conservative to comply with the standards of the UAE rather than face penalties in the UAE. That's something we have seen so far in the last a few years with value-added tax regulations, economic substance regulations, and excise tax regulations as well, right? Yeah.
Yeah. Okay. Great. Thanks, Curti. So now Q&A session is closed, but before we close the webinar itself, Curti, I wanted you to tell me what are the key takeaways of today's session to our participants, please?
Sure, Kath. Yeah. Firstly, it is important to identify the control transactions and comply with the TP requirements. Secondly, important, it is not just the cross-border transactions, domestic transactions are also subject to transfer pricing requirements, and hence we have to ensure arm's length principle is met. Lastly, the taxpayers must plan ahead so they can mitigate any risk of non-compliance, which includes additional tax liabilities, losing the free zone relief, and possible penalties.
Okay, yeah, thanks, Curti. Well, after this session, I believe it's quite clear, at least it is to me, that UAE taxpayers must plan ahead, take action, and maintain transfer pricing compliance at all times, isn't it, Curti?
Yes.
All right, this was a great session. Thank you, Christos, Gaspar, and Curti for participating in this webinar. I'm sure it was very useful to all our audience. As I said at the beginning of the session, we will send all the materials to everyone who attended this webinar, and the team will obviously be on hand in case you have any further questions. You can just contact them directly. They will be happy to assist you. Thanks again, all of you, and have a nice day ahead.
Thank you,
Thank you.
everyone.
Thank
Pleasure,
you.
guys. Thank you, everyone.